All right, let's talk about Poonawalla Fincorp. This company has gone through a huge transformation, and a new equity research report is saying it's at a really critical moment. So today, we're going to break down that analysis and figure out what's really driving this change.
So what's the big idea here? The research is pretty clear on this one. Poonawalla Fincorp is now a digital credit powerhouse, and it's standing at a major strategic crossroads. Seriously, if you think you know this company, you might need to think again. It's a whole new ballgame.
Okay, so let's start by unpacking that. What does it actually mean to be a digital powerhouse in this space?
This really gets to the heart of it. The company has basically thrown out its old, heavy, legacy model from the Magma Fincorp days. Now, it's all about being digital first, running on a really sophisticated, tech stack-led credit engine.
And you can see the results of this digital shift right here. I mean, the proof is in the pudding, right? Their assets under management, or AUM, have just exploded to a record 55,017 crore rupees. Let that sink in. We're talking about a 77.6% growth year on year. That puts them on a kind of hyper-growth path that very, very few of their competitors can even dream of touching.
So, what's the engine behind all this? The research boils it down to three main things: technology, brand new leadership, and, you guessed it, a whole lot of capital.
First up, let's talk tech. They've built this incredible competitive moat with 57 live AI projects that are automating the core of their business. And look, this isn't just about being a little more efficient. This is about creating a lending machine that runs with almost no human touch, which gives them a massive edge in the industry.
And here's what that actually looks like in practice. A full 28% of their prime personal loan disbursements are completely zero touch. Think about that. From the application all the way to the money being in your account, no human intervention. That's the key. It's a scalable architecture that lets them grow their loan book without all the usual expensive overhead.
All right, pillar number 2, leadership. Bringing in Arvind Kapil as the new MD and CEO is being called a total game changer. Why? Well, his background is from HDFC Bank, and he's bringing what the report calls the HDFC DNA with him. That means a super disciplined, risk-first, governance-first culture. It's all about prioritizing the quality of the loans, not just chasing aggressive growth at any cost.
And to make all this happen, you need fuel. They are building a massive war chest with a plan to raise a staggering 25,500 crore rupees. And this capital isn't just a safety net. No, it's an offensive play. They're going after market share and are ready to take on the bigger lenders.
And finally, let's talk about how they're managing that capital. Regulators like the RBI are keeping a close eye on unsecured lending these days, so the company's been proactive. They've rebalanced their portfolio to a 56-44 ratio of secured versus unsecured assets. It's a really deliberate move to de-risk the books and stay ahead of any regulatory changes.
Okay, so with that foundation in place, let's look at the bull case from the research. What's the argument for why this incredible growth can actually keep going?
So the bull case really comes down to three main things. First, you just can't ignore the sheer momentum of that 78% AUM growth. It's huge. Second, with that massive capital raise, they've basically taken any liquidity problems off the table. They have all the fuel they need to expand. And third, the new management has brought in that institutional-level discipline, which is absolutely critical for building investor confidence.
And you can see a really tangible result of this whole transformation right here. The market is noticing. Look at their cost of borrowing. It's dropped to just 7.65%, which is one of the lowest in their peer group. Now, why does that matter? It's a huge signal of powerful operational leverage. Basically, they can borrow money cheaply and lend it out competitively, which is fantastic for their profit margins.
And this growth isn't just coming from one place. They're being smart about it, adding new engines to the machine. They're diversifying it to high-yield areas like gold loans and are already seeing amazing success with new products. Take their education loans, for example. They've already logged over 16,000 files. That just proves they can jump into new areas and scale up fast.
Okay, but a good analysis always looks at both sides of the coin. So now we have to turn to the bear case and look at the major risks and headwinds that the research points out.
The research highlights three big risks here. First, there are regulatory headwinds. The Reserve Bank of India is still very watchful when it comes to unsecured lending, and that could always change things. Second, there's market risk. This is a highly volatile stock, with a beta of 1.32. In simple terms, that means it tends to swing more dramatically than the overall market. And third, you have historical risk. The market has a long memory, and people haven't forgotten the asset quality issues the company had in its past life.
So when you put it all together, the good and the bad, what's the final verdict from this research? Where does Poonawalla Fincorp really stand today?
This chart right here is so important because it signals that the pain phase is officially over. They're back to strong profitability, posting a Q3 FY26 profit after tax of over 150 crore rupees. This shows they've finally moved past that tough period of cleaning up the old, legacy assets.
And that brings us to the final conclusion of the report. It frames Poonawalla Fincorp as a high beta compounder. The story has completely changed. It's not just a turnaround anymore, it's a story of a structurally profitable company set for growth. Now, I have to be crystal clear here. The buy rating you see on the screen is the conclusion from the source research we're breaking down. It is absolutely not financial advice.
And this timeline, wow, it just pulls the whole story together so well. Let's just take a second here. It all kicked off at the acquisition back in May 2021. Just 2 years later, by 23, they're in the middle of this massive digital overhaul called Project Sanjeevani. Then in 2024, the new leadership comes in, which paves the way for the huge tech brand investments of 2025. And all of that led to those strong Q3 results and the massive fundraising plan in January 2026. It's been a truly incredible transformation in such a short amount of time.
So all of this leaves us with one big final question. Their target is a massive 1 lakh crore AUM. The real question is, can their powerful new digital engine and their disciplined risk culture actually outrun the very real risks that come with a high beta, super aggressive growth strategy like this? That's the billion-dollar, or I guess the 1 lakh crore question.